$1,359,000. Yeah, that is a staggering number. But that's not how much this company made. That is this company's accumulated deficit, literally the total massive amount of money they've lost since the very day they opened their doors. Now, you might think a number like that means a business is on the absolute brink of collapse, right? Well, in the wild frontier of frontier technology, sometimes bleeding cash is just the steep price of admission. Welcome to the EDGAR Brief. Today, we're cracking open the Q1 2026 10Q from D-Wave Quantum Inc., ticker symbol QBTS, filed on May 12, 2026, and we're going to translate it into plain English. Quick note before we jump in. We're independent, not SEC affiliated, and we are absolutely not financial advisors. We use AI to summarize, so errors can happen. Always verify on sec.gov before making any money decisions. Okay, let's dive into this. Welcome to D-Wave. So, with $1 billion of historical losses, you're probably wondering, how does a company actually try to make money on quantum physics? These computers are incredibly complex machines. I mean, they operate at temperatures colder than deep space. To monetize them, D-Wave uses a model they call QCAAS, which stands for Quantum Computing as a Service. Basically, think of it like a high-end gym membership. You don't have the space or the cash to put a $10 million piece of heavy, complicated machinery right in your basement. So D-Wave builds the gym, maintains the equipment, keeps the lights on, and you just pay a subscription fee to access that heavy machinery via the cloud. You log in, run your complex calculations, and log out. Simple as that. And that gym analogy actually perfectly maps to D-Wave's three distinct revenue streams. First, you've got that QC as cloud gym membership. Second, you have professional services. This is where D-Wave sends in their experts to help customers figure out how to actually use these crazy machines. Basically, they're the personal trainers of the quantum world. Finally, you have system sales. This is for that rare, deep-pocketed customer who actually does want to buy the entire gym and put it in their own basement. We're talking multi-million-dollar hardware purchases here, complete with installation and calibration. Moving on to Section 2, the Q1 scorecard. Now that we know how the cash register works, let's look at the hard numbers to see, are more dollars walking in the door compared to this exact same time last year? And wow. Okay. In Q1 of 2025, D-Wave brought in a very respectable $15 million in revenue. In Q1 of 2026, just under $2.9 million. That is a massive 81% year-over-year revenue drop. On the surface, yeah, that looks absolutely terrifying. But remember what we just said about buying the whole gym for your basement? Hardware sales are incredibly unpredictable. So let's break down this quarter's $2.8 million to see exactly what happened here. QAAS, those cloud subscriptions, actually grew a bit to $1.76 million. Professional services, the personal trainers, also grew slightly to about $1 million. But system sales, the hardware, it practically vanished. Last year, they booked $12.6 million in system sales in the first quarter. This year, just $86,000. Listen, when your business relies on selling a handful of massive multi-million-dollar machines, missing a single sale on a 3-month window makes your revenue chart look like it literally fell off a cliff. So the revenue is way down, which brings us to the next crucial metric, free cash flow. Because you know the rule around here, accounting profit can be a complete fiction, but real cash left over, cash isn't. So, if revenues stop tomorrow, how long until lights out? Well, in Q1, D-Wave's operations burned through $45 million in cash. That is a seriously heavy bleed rate. However, if you look at their balance sheet, they're sitting on a combined $588.4 million in cash and short-term U.S. government bonds. So yes, they are bleeding money, but they've built a massive war chest to survive it. They certainly aren't going broke tomorrow. Section 3, digging the moat. Now, if they have all this cash, what's stopping a giant tech competitor from walking in and just crushing them tomorrow? What protects them? Well, D-Wave's durable advantage really comes down to being a pioneer. The filing explicitly highlights that they are the world's first commercial supplier of quantum computers, and uniquely, the very first to offer dual platform systems, meaning both annealing and gate rodel. Furthermore, their Leap cloud service boasts a 99.9% uptime. And let me tell you, in the enterprise software world, reliability is a massive switching cost. If your customers are used to your cloud never, ever going down, they are going to be extremely hesitant to switch to a cheaper, unproven competitor. Section 4, reading between the lines. Okay, let's dive into management's discussion and analysis. This is where management tells the story behind the numbers. And the big story this quarter, why their operating expenses absolutely skyrocketed. Remember that $45 million in operational cash burn we just talked about? Well, their total cash out the door was actually vastly higher because of this exact number. $250.8 million. In January 2026, D-Wave used a massive chunk of their war chest to acquire a company called Quantum Circuits. And get this, that was just the cash portion. They also handed over roughly $282 million in stock to make this happen. The thing is, buying a huge company doesn't just cost you the sticker price, it forces you to absorb all of their daily expenses too. You can see this directly in D-Wave's cost spikes this quarter. Research and development more than doubled from $10.3 million to nearly $25.8 million. General and administrative costs jumped from $8 million to over $20 million. This huge acquisition is the primary reason their total operating loss ballooned to nearly $55 million this quarter. So yeah, they bought growth and they bought cool technology, but they also bought a significantly higher daily burn rate. Section 5. Red Flags and Risks. Item 1A in any SEC filing is written by lawyers to cover every single possible disaster scenario. You know, everything from minor supply chain hiccups to literal asteroid strikes. But cutting right through that boilerplate, we see 3 tangible, immediate risks to this business right now. First, that extreme reliance on rare, lumpy system sales. You just cannot smooth out your earnings if a $12 million machine sale gets delayed by a single month. Second, we've got an accelerating operating cash burn. Integrating Quantum Circuits is turning out to be incredibly expensive. And finally, look at their geographic risk. In Q1 of last year, they made $12.8 million in Germany alone. This quarter, just $175,000. When your customer base is that concentrated, one single country tightening its IT budget can completely tank your entire quarterly report. Section 6. The bottom line. So, bringing all this analysis together, what is the fundamental reality of this company right now? Well, the verdict is basically this. D-Wave is a cash-burning pioneer with a massive war chest, but a highly unpredictable sales cycle. They have incredible first-mover technology and a bank account big enough to survive a long, expensive research phase. But right now, today, their actual revenue is at the absolute mercy of a few giant, lumpy hardware sales. So, for the next filing, here are 3 specific things you should track. First, does the Quantum Circuits acquisition actually start generating its own revenue? Second, does the operational cash burn start to level off, or does it keep climbing? And third, how fast are those QCaaS cloud subscriptions growing? Because ultimately, for this business to ever stabilize, those smooth cloud subscriptions need to become the start of the show. And that's your EDGAR brief on D-Wave. Remember, this was a translation, not a recommendation. Read the original on sec.gov if anything piqued your interest. Thanks for being with us at the EDGAR Brief. See you in the next filing. Until then, can smooth cloud subscriptions eventually replace lumpy hardware sales?